every Monday to Friday. This is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis welcoming you to my podcast Money Talk for Tuesday the 6th of February. It's the final week of the year of the rabbit, and we welcome the year of the wood dragon on Saturday. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, former US President Donald Trump has said he would impose more tariffs on Chinese goods if he won the US presidential election in November. In an interview with Fox News, he said the tariffs could be in excess of 60%. He said in the interview on Sunday, "I'm not looking to hurt China. I want to get along with China, but they've really taken advantage of our country." And he rejected criticism that the moves would start a trade war, saying that he did great with China with everything during his presidency. Federal Reserve Chairman Jerome Powell vowed in an interview aired Sunday that the US Central Bank will proceed carefully with interest rate cuts this year and likely will move at a considerably slower pace than the market expects. Mr. Powell expressed confidence in the economy and said we can approach the question of when to begin to reduce interest rates carefully. 14 Chinese regions have been told by the Ministry of Industry and Information Technology to stabilise manufacturing and ensure a good start to the Year of the Dragon as the sector struggles in the run-up to the Lunar New Year holiday. Officials want a good start to the new year as concerns mount over the pace of the economic recovery. And China pledged to stabilise financial markets after shares sank to a 5-year low last week. However, policymakers offered no specifics on how they plan to bring an end to the sell-off that has wiped out around $7 trillion from the market value of Chinese and Hong Kong equities since a peak reached in 2021. On Sunday, the China Securities Regulatory Commission vowed to prevent abnormal fluctuations, saying it would guide more medium and long-term funds into the market and crack down on illegal activities. And China's also tightening trading restrictions on domestic institutional investors as well as some offshore funds. On today's Money Talk, we're joined by Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Frederick, Managing Director of Magnum Research, and our US economics correspondent, writer and broadcaster, Barry Wood. If you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street's Monday, US stocks sank following the release of positive services PMI data and after Federal Reserve Chair Jerome Powell pushed back against hopes for rapid interest rate cuts in an interview on CBS's 60 Minutes on Sunday. The S&P 500 slipped 0.33% to close at 4,943. The index hit a record high last week, boosted by big tech stocks. The Nasdaq Composite edged down 0.2% to end at 15,598. And the S&P 500 and Nasdaq came off session lows as Nvidia led gains in the chip makers. The Dow dropped 274 points, that's 0.7%, to settle at 38,380, having been down more than 430 points at its low of the day. Benchmark 10-year Treasury yields rose 14 basis points to 4.17%, and that extends their 2-day gains to 30 basis points now, and triggering sharp selling pressure for sovereign bonds worldwide. 2-year Treasury yields rose 10 basis points to a 1-month high of 4.48%. The US dollar index extended gains to 0.7%, trading at 104.5 on Monday. That's the highest level since mid-November, after new data added to evidence that interest rates will not be lowered as soon as previously anticipated. The dollar was 0.2% firmer against the yen at 148 2/3 of a yen per dollar. The offshore yuan depreciated past 7.22 per dollar, hitting its lowest levels in nearly 3 weeks as the dollar rallied. Gold slipped to 1-week lows, ending the day 0.7% lower at $2,024 an ounce, and oil prices were steady. Brent crude futures settled unchanged at $77.33 a barrel. Chinese stocks posted more wild swings on Monday. The CSI 300 rose 0.7% for the day to 3,200 after falling as much as 2.1% earlier on Monday to a 5-year low. However, the index is down almost 7% for the year. Gauges of small cap shares closed deep in the red red. The CSI 1000 index of small companies slumped as much as 8.7% early on Monday before closing down 6.2%, and that's the 7th consecutive losing session. Hong Kong's Hang Seng Index edged down 24 points, or 0.2%, to 15,510. It was the second day of losses, coming after Jerome Powell tempered expectations of rate cuts. The Hang Seng Index has dropped 9% this year so far, after 4 consecutive years of losses, and it makes it the worst performing equity benchmark in the world in 2024. It does look like we're going to get a small rebound in Hong Kong stocks at the open. Futures markets pointing to a gain of about 45 points. The index should start trading around 15,555, and you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our Tuesday morning guests. We have with us Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia. Morning, Mark.
Good morning, everyone.
And also with us, Frederick Chu, Managing Director at Magnum Research here in Hong Kong. Morning, Frederick.
Good morning, gentlemen.
And over in Washington, D.C., we have our US economics correspondent, Barry Wood, and it is traditional on a Tuesday morning that we kick off with a weather forecast.
Yes, it is cold, it is dark, but the days are getting longer. So I would give you a forecast for the week in Washington of mild temperatures, milder. Snow is completely gone. Things are looking a little bit up.
It's almost worth flying over there, isn't it? Now, in Washington, former US President Donald Trump has said he would impose more tariffs on Chinese goods if he wins the presidential election in November. In an interview with Fox News, he said the tariffs could be in excess of 60%. We have to do it, he said in the interview on Sunday. You know, obviously, I'm not looking to hurt China, he said. I want to get along with China. I think they're great, but they've really taken advantage of our country. And Mr. Trump rejected criticism that the moves would start a trade war, saying that he did great with China with everything during his presidency. Barry, I don't know if you saw this. I mean, his raised flags over a general import tariff before of 10%, but 60% at least on Chinese goods. Is he serious? Are you shocked to hear this?
Yes. And yes, I think he's serious, but I don't think it's going to happen. Even if he were elected, I don't think that's going to happen because 60% means essentially no imports from China. I mean, you just can't have that kind of tariff and have a price that is competitive. Now, there are some goods that no doubt would be, but they would cost so much and it would hurt the American consumer. But he's really, we'd almost forgotten how Donald Trump can say, yes, but. And the but is, oh, I like Xi Jinping. We get along famously. And we'll be fine. But we have to do this. We have no choice. Well, I think that his popularity with the business community would vanish if he were to go in that direction. So I think it will be taken as a warning. It will be taken as something that is not going to happen, but he is, after all, by his own words, the tariff man. He likes them. So the 20% that he levied when he was president, they're still in effect, most of them. And, we're just not used to hearing this kind of rhetoric. And here it is once again.
Do we have to start listening to him more now as we get closer and closer to the election?
I'm afraid so. I keep talking to Democrats who say, look, I think Trump is going to win. I can't really believe that they're saying that, but people are saying it. I think it has a lot to do with the lack of popularity and the alleged problems physically and mentally of the current president. But I think that so much can happen, right, Mark, before we get to November.
Right. I think he definitely could win. I'm not so sure that he will win, but we don't even know who's going to be running in the end, as you've said many times before, Barry, because it's a very fluid situation. Is that a nice way to put it?
It is.
On the tariffs, as it happens, last night in my class at Chinese University, the topic was trade wars, which was very appropriate for the subject. And my students are mainly from China. And the the issue is this: not only government reaction, it's their reaction to these kind of statements, whether, as Barry says, it's really going to happen or to what extent. It just sends the wrong signals, and it just makes them double down on what they were doing anyway. And, supported, I think, generally by these are pretty intelligent people who are pretty wide ranging in their viewpoints. But at the same time, this really hardens them to some extent. And of course, you put out some of the numbers already, Peter, on what the impact was. As you mentioned, the conservative think tank talked about the previous impact of almost $200 billion that's cost Americans almost $200 billion and 245,000 jobs. I don't know if those figures are accurate, but they probably aren't far off. And that's who it hurts. So in addition to the business community, American consumers eventually might get it that this is not particularly good for them.
Mm-hmm. Frederick, what do you make of this? I mean, the US is sort of destroying its own market for Chinese goods, isn't it? I mean, the US is no longer China's biggest export market now. It's been overtaken by Mexico and Canada. And at this rate, it'll be overtaken by several more.
Yeah, I think this is the least that the Chinese government want to see. I think they are ready for two things. Number one, it's Donald Trump could win the upcoming election. And second of all, if he wins, then he will very likely continue what he did in his previous, regime. So which means that the U.S.-China tension is going to be bring back on. And I think China, it's getting ready for to tackle that if it hurts the export. Furthermore, if it hurts the supply chain on the tax and etc. One of the biggest self-protection for the Chinese government is to do the inner circulation. I mean, the domestic demand-driven type of economy. If you imagine the goods and services produced and be digested in domestic China that could still sustain for a longer period of time. But the thing is, the consumer confidence in China is so low at the moment, and when you look at capital markets, as you can see, the governments it's still capable of supporting capital markets, running by itself. So unless you close up everything and try to circulate everything on your own, that would serve as a interim solution. I think that's in the mind of the Chinese government.
It's going to be tough, though, isn't it? Because there's certain sectors now, like electric vehicles, like batteries, where there's massive overcapacity, and the domestic economy can't absorb all of that manufacturing capacity, so they need to export it to overseas markets.
That's right. I think it's across all sectors, and the authorities dealing with them one by one. First one to come in, obviously, is the real estate. So the crackdown, the problem with the real estate developers. Now they come up with a white list that they're willing to fund on the project basis for those developers. Those are not really for the developers, but more for the consumers, for the home buyers. So the second sector come up could be the EVs. As you see, the price wars are coming in pretty massively. I think it's across the board that that's a more structural problem for China at the moment.
Mm-hmm. A couple points, Peter, in reaction. I mean, actually agree, and I think good points. The other problem is, of course, the barriers to exports like EVs in the United States and elsewhere. There was just a piece done by Bloomberg about a month ago talking about tariffs under the Biden administration. As mentioned, they're almost as bad as in the previous administration, and there doesn't seem to be any indication that they're going to be. Barry might disagree that they're going to be loosened. And what this means, in effect, for companies, for example, they're scrambling to figure out how to move some of their production from China to other places that don't have the same barriers, like Vietnam or others who can export directly to the U.S. or Mexico or some other places. And the other accompanying development is, of course, Chinese suppliers, medium-sized firms in most cases, are moving with a lot of these multinational companies to Vietnam or to Mexico. Now, how that affects the overall Chinese economy, I don't know. it's good for them, but that means they reduce or maybe end a lot of their production in China itself.
I would take the position that Mr. Trump's statement will convey clearly to the Chinese leadership that they need to accommodate their largest export market. And, trade was down between the two countries, Chinese exports to the States down 13% last year. And this is a clear warning, that all the tension that existed began with the Trump administration, has continued largely in the current administration. China has to be more accommodating to get this trade deficit that the United States has with China down to a more manageable level. Now, on the other hand, all the things that were set in motion by Janet Yellen and by the Xi-Biden meeting in November are coming to pass. I mean, here is the third meeting of a working group in China that was set up. This is positive. So it's not all bad news, but clearly, if the Chinese leadership thought that Mr. Trump was out of the picture, I think they'll think again.
But Barry, and I agree with you, of course, and I think I hope there is a move toward greater accommodation, and we've seen it in some of the greater interaction between the U.S. and Chinese government. But the one area where it's not so clear is in trade. That it wasn't really discussed between Xi and Biden. Our Secretary for Commerce has made some pretty strong statements in the past month or so that were not very favorable. The USTR is taking a pretty hard line as well. So that's the area where I don't think we've made much change. I mean, from the Chinese side, they've also taken some measures that aren't so helpful either, especially in rare earths and other areas like that, which are pretty key to a lot of things that everyone manufactures. But I agree with you. There really has to be, I think, more focus on this area, and I hope both governments do that.
Frederick, do you think President Xi Jinping, does he want to make any accommodation to accommodate export markets in the US and Europe? Because you sort of get the feeling that this industrial model is so embedded in the system, in Chinese economic policy, that they can't wean themselves off of it. And we saw that, didn't we, when we had the meeting with the EU leaders and President Xi in Beijing at the end of last year. They really got nowhere. It was a standoff. Beijing wasn't prepared to abandon its industrial policy, and the EU wasn't prepared to back down on making sure that it carried on with its investigations into dumping and subsidies and so on.
Yeah, I think that in the mindset of the Chinese government, U.S. it's always to be the biggest partner in all senses, in all areas. So that's why I see for the previous or current U.S. administration, the Chinese government basically taking a more passive way in dealing with all these tensions. Like they have come back with some sort of barriers or sanctions, but it's just the response for so many times, so many things that the U.S. Government has done. So I think as a hedge, as what the Chinese could do is to go to some other parts of the world to look for. Outsource, look for buyers, for instance, in the Middle East, look for new markets, new demands. Go down to Vietnam and Southeast Asia along the Belt and Road, just to looking for additional outsource that could potentially get around with the barriers.
Barry, what has happened to the Republican Party? I mean, the Republican Party, it used to be the party of free trade, low taxes, no tariffs. I mean, that was the party of Ronald Reagan, wasn't it? I mean, it's almost as if they've sold everything that the Republican Party used to stand for in order to make sure that Donald Trump is elected.
I wouldn't fully agree with that. I think that the Republicans indeed are split. There's no doubt about that. In fact, they're probably split more than two ways. But they want to win. And Nikki Haley is playing a successful hand, it seems to me. They wanted her 2 weeks ago to drop out. She didn't. Now I think she's playing the card that says Donald Trump cannot win and that this race is not over, despite all the experts saying it is over. So, she's a Republican after all, Peter, and she probably espouses some of the policies that you're associating with Ronald Reagan. So I wouldn't say that they've thrown out all these policies. The big policies, as I see it, and I saw it in South Carolina, are, first of all, the border, the open southern border. Secondly, it's crime in the cities, and the fact that it's seen to be these sanctuary cities that are causing problems. And then all the regulations that exist. And so as long as poorer people, including some blacks and some Hispanics, are rallying to Donald Trump over these issues, is a sign that the Democrats have not got clear sailing ahead. But as to your initial point about the Republicans, they're split. And we'll see much more of that in the next week, because they've got to vote on a Republican and Democratic Senate package that would give aid to Israel, give aid to Ukraine, and do something on the southern border. The House Republicans say, no way. We'll see who's going to be the stronger faction within the Republicans. We'll see that within 7 days.
Are there Republicans who just can't bring themselves to vote for Donald Trump? Is there a constituency there that's significant enough of people who call themselves Republican but say, I just can't vote for this guy?
Yes, there are, but they're small in number. That would be the former senator from Utah, Romney. I mean, there's no way he could support Trump. And look at the people in Trump's cabinet who said the guy cannot possibly be trusted with the reins of government again. So, I think it's, we'll see.
Okay. Well, let's move on. The China economy, Mark and Frederick, we had some data out overnight. The Caixin Services PMI came in a little bit below forecast, although it was expanding, 13th straight month of expansion. The composite PMI, which combines the manufacturing and non-manufacturing gauges, was at 52.5. There, China is telling its regions to pull out all the stops to try and make sure that the manufacturing sector gets a good start to the new year, which begins on Saturday. And of course, this is a traditional time when lots of factories close down for the holidays. What are your thoughts, Mark, first of all, on where we are on the economy? Any signs at all that the authorities are getting to grips with this, or are you on the lines of maybe the US-based Rhodium Group, which said yesterday in a report, we've got to get used to China's economy growing at just 3 to 4% in the coming years?
Well, I think they both could be right to one extent or another. Of course, we don't know. And our forecast for this year, for example, is sort of the mid 4% or mid to high 4%, which by China's historical standards isn't very high, but compared with the rest of the world and the size of the Chinese economy, not so bad. And of course, China and government is pulling levers to try to help the property market, try to help the stock market, try to buoy consumer spending. And I think it's going to have an impact. It's just still, we're in a situation, I'd like to hear Frederick's view on this too, but from our members, not all of them, but many of them, it's still not meeting expectations that they once had, which maybe were unrealistic expectations. And they aren't sure where they're going to find the income in other parts of the world. So China is still really important to these companies, but they got to find alternatives because it's not going to be quite, even though it's going to be better and maybe a little bit more stable, it's still not going to be quite what they'd hoped.
Yeah, I definitely think so. I think if you know China good enough, you probably know the numbers doesn't really reflect the practical, economic situation all the time. We talk about the consumer, the PMIs looks not that bad, but actually, if you go down to the ground and look at how people spending money, it's actually way behind the pre-COVID times. I've been spending much time in Shenzhen these days, and the consumption has been restoring. If you go to restaurants, shopping malls, it's full of people, but a portion of them obviously coming from Hong Kong. But for the locals, I think first of all, about 2 million people from the outer province in Shenzhen has left and go back to their hometown. So substantially lowering the labor forces, drive up the labor price. But lucky thing is Shenzhen still have many people, so this is not really a labor shortage that could drive up the cost substantially. The spending habit is changing, even though people are more willing to spend money out there. Given credit to the service level from the service sectors is improving substantially. So people are more willing to go out, but the way they spend money, the way they go travel to Hong Kong or anywhere else in the world, it's not the way. How they spend money before COVID. So I think it's quite a long way to go for China really to pick up from where they are. But having said that, I think it's still February. We haven't got to a Chinese New Year yet. I think it's still quite early to put a very confirmed stance on whether China can meet 5% this year or not, because if the state set 5% GDP, it's basically a must reach. So I think after Chinese New Year, especially before the two sessions in March, we're probably going to see a bit more stimulus coming out, a bit more meaningful stimulus coming out that could really get down to the real economy.
Do you think we got to lower our expectations? 3 to 4%. We've got to get used to that going forward. Eventually,
yes, because the 8%, 10%, we're never going to go back. And like Mark has said, 3 to 4%, it's pretty good in the global sense. But for China, it's sometimes it's just different. Just looking at the economic angle.
Sorry, Barry.
I wanted to ask if I could about Shenzhen and its at least two big employers, BYD and Huawei. How are they doing?
BYD is doing fine, I think. Yeah, by looking at the sales figures and the productions, is becoming the biggest EV producer in China. And talking about the EV market, you go to tier one cities like Beijing, Shanghai, Shenzhen, you will notice the usage rate of EV is quite high. Like at least all the taxis are EVs now, all the buses are EVs now. But if you go to like the inner China or some, more, Western part of China, for instance, the adoption rate is still room to grow. So I think the EV market for domestic China is still quite a good piece of cake to compete with. That's why you see Xiaomi and all those, new brands are coming into this competition. Huawei. I just don't think Huawei has much worry about, the sanctions. Well, maybe in a global sense, yes, they do. But for domestic consumptions, like the new Huawei phone that they just came out several months ago, it's really a crack to the market. I think, I know a friend who's in the semiconductor industry in US. Huawei used to be one of their biggest client. He told me like 3 years ago, before COVID, Huawei has already accumulated enough storage for maybe 5 or 6 years of demand of need. So yeah, I think it's being impacted at the global level, but for satisfying the domestic demand, I think they're more than enough.
Mm. How much is the slump in the stock markets that we've been seeing over the last few weeks damaging the economy and damaging confidence, consumer confidence in particular?
You mean China?
Yes.
The stock market, it's if the government wants to beef up the stock market, they can do it easily overnight. They got cash, they got foreign reserve, they can do it right away. Just imagine that the regulators, the market players, the brokerage firms, the banks, the asset owners, everything was owned by the state. So they set the rules, they open up the floor, and they have all the players. So if you want to make it up, you can make it up overnight. If you want to leave it like that, you can just leave it like that. So I don't worry about like how the stock market is doing, but it's really I think the number one is the real estate market that's hurting the investors' confidence. Secondly, the performance of the majority of investment products in China last year has been quite disastrous. So that means most of the people are still out of money with their portfolios. So they do not want to engage into, just normal listed equities. But we do see some risk on in China, like certain of the professional investors, like high net worth. They are more eager to go into the private side of things, like buying the private equity projects or private debt, those type of investments.
Mark, is this something your members are focused on, the slump in the Chinese market and the impact it's having on business, on consumers overall?
Yeah, absolutely. I mean, consumer sentiment is part of it, and also their disposable income, which is still substantial, but the willingness to spend, as Frederick has suggested, is still not there. Now, part of this is a remnant of COVID and the impact that it had on everyone, but the stock market and property market are really key to a lot of people in China, and that's where a lot of their investment is. And until they see light at the end of the tunnel and feel a little more confident of that, plus also a little bit more backup on the safety net, for housing and for health and education, I think they're going to be reluctant. And this is, as it's not always reflected in the numbers, as Frederick says, but it is reflected in consumer sentiment, even for lower priced items. It's not the expense. It's, they'll buy less of something. That's what's happened.
And clearly investors are very aggrieved about this, aren't they? You just have to look at what happened to the US Embassy in Beijing. Their Weibo account, some 53,000 users posted on it over the weekend, won over 300,000 likes, complaining about what was happening to their investment and the stock market, because it's one of the few places that's not controlled by the state, so they could freely express their grievances. It clearly is top of people's minds at the moment.
Well, are they blaming the United States, or is that
no? It was just
blaming their own government.
Blaming their own government,
yeah.
But it's just that on the United States social media account you can post freely; it doesn't get scrubbed all your comments. Whereas if you did it on a lot of other accounts, the Chinese government would scrub it. So it's one of the few places where you can actually freely post your grievances, of which clearly there were a lot. Of course, Barry, not a problem that you've got in the United States at the moment, with markets at all-time highs, almost.
It is. It is remarkable and unexpected. And certainly Jay Powell is a happy guy.
Now, he's giving a lot of interviews, isn't he, making it clear that March rate cuts are off the table. I mean, we've spoken about this on the programme before, thinking that was too ambitious, but he is spelling it out now for the markets, isn't he? No rate cuts in March, and quite possibly not one in May either.
Well, he doesn't put it as forthrightly as you do, Peter, but he does say that the evidence would suggest that we're not going to have enough progress that we would cut rates in March. I thought in this interview that was broadcast Sunday evening here, is that he made clear that he wants to cut rates in the course of 2024, and that he expects to do so. But as you just said, it's going to come probably mid-year, certainly not in March, and that might explain why we've had this rather significant stock pullback on Monday.
And how on earth can he cut rates at all when, once again, these US job numbers just blow expectations out of the water? 353,000 jobs in January. I mean, we've marveled, Barry, haven't we, several times over the job numbers. This is, I think, the biggest one we've seen for a while.
Yes, that's right. And it's happening with inflation holding steady. So you've got 3%. It hasn't gone up. So yes, the Fed will be data dependent, but as you've just said, with both the job data and the high interest rates, the economy continues to chug along and do very well. So be it. And that should be reflected in increased popularity for the president. That has not happened as yet.
Where are all these jobs coming from? It just seems almost inconceivable that month after month the US economy can keep creating, well, hundreds of thousands of jobs. Just where are people coming from? I mean, I hear that maybe, there are quite a few people that have several jobs and there's a lot of increase in part-time working, but I just can't understand how you find all these people to give jobs to.
Well, it's mostly in the service sector, and there's so much money. I mean, anybody can get a job in a restaurant or a supermarket, and those places are doing a very brisk business. I think travel is a huge industry. And that's doing very well. So, yeah, we're not adding a lot of jobs in some types of manufacturing, but there's a lot of government money, talk about industrial policy, we have it here, that's gone into semiconductors. So there's a lot of construction. I think the remarkable thing in all of this is that high interest rates and a commercial real estate sector that is suffering because you've got downtown areas with office buildings that are unfilled because people are working from home. And yet, next door, there's construction going on and there's a housing boom. So it's quite counterintuitive, but it's happening all over the country.
Are you surprised, Mark, just how little damage these high interest rates have done to the economy? Well, certainly haven't done much damage to the US economy. They've probably done more damage to the Hong Kong and China economy and others than they have to the US.
Clearly, to a great extent. Yeah, of course, I'm surprised. And I think most forecasters got it wrong. And eventually, some of them are now saying, well, it's still coming, or there's still going to be a pullback, and maybe there will be. But at this point, we keep getting numbers like you've just described, like Barry just discussed, and the sentiment is still pretty strong.
Frederick, what could get the Fed to cut rates?
I think if you look at the payroll is definitely very, impressive. I think, one factor that we could probably reference to is the PCE, which stands at 2.6 at the moment. Generally, I think the interest rate that the Fed, I think reasonable interest rate is somewhere at the current PCE plus about 200 basis points. So which means that the reasonable rate, it's right now, given the PCE is 2.6, so it should be at 4.6 or something like that, which gives some speculation to the market that this year the Fed may cut about 100 basis points. But I think March, expecting a March cut or May cut could be a bit more too optimistic, to be honest. I think we're going to see a high interest rate environment at least until middle of this year.
And we desperately need an interest rate cut here in Hong Kong, don't we? The PMI data once again showing that private sector growth has gone and stalled again.
Yeah, I think so. I mean, the Hong Kong, the high interest rates is killing the investment appetite for the past 12 months. That's a definite thing. So lowering the deposit rate, it's going to help the investment appetite. Somewhat different from China. I mean, China is going on low interest rate at the moment. You put money in the bank, you basically don't get anything in return. But still, people are not willing to spend. So I think it's going to help Hong Kong. But the good thing for the China is if they can see the rate cut roadmap for US, will be given them, given the government maybe a little bit more room to give the market a further push on the monetary policy, because the major task for China right now is to curb the outflows on investments, on spendings, on anything. They just want to keep the cash. People's cash within the country. So, it's affecting the entire financial, sectors, the financial players, the Chinese financial players, basically, whether it's a bank or securities brokers.
Mark, final word to you. The Hong Kong economy, the PMI, pretty well stalled, 49 points, 9. Once again, we just can't seem to get any traction here, can we?
No, it's true. And of course, we're going to, at the end of this month, the financial secretary is going to introduce his budget. And so he hasn't been exactly real upbeat on the prospects for the Hong Kong economy recently. And I think the government's going to have to consider if they're going to try to take measures, but taking those measures are going to be restricted because they have a significant deficit, which is something that Hong Kong is not used to having for many years, and it has to operate within that, plus the uncertain prospects geopolitically and in other areas that we've just discussed. So this is going to be, I think, one of the more interesting budgets.
Okay, well, thank you all very much for your thoughts this morning. You heard there Mark Michelson, who is chairman of the Asia CEO Forum at IMA Asia, Frederick Chu, who's managing director at Magnum Research, and Barry Wood, who's our US economics correspondent based over in Washington, D.C.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning. I'll be back tomorrow with more business and finance headlines, and to discuss them, I'll be joined by Enzia von Pfahl, capital preservation specialist at Financial Shield, our regular Wednesday correspondent, and also William Marr, who's chief investment officer at Grow Investment Group. Please subscribe to my daily newsletter, which contains updates on business and finance news from the Asia Pacific region and affecting Asia. You'll find it at peterlewismoneytalk.substack.com. See you tomorrow.
Money Talk